Hey everybody, Blev here. If you watch to the end of this video, I'm going to teach you the simple way to avoid a huge number of traps that the stock market, stockbrokers, trading platforms, and trading gurus have put in place to take your money. Like, subscribe, and watch to the end. Let's go. Day trading takes a lot of time every single day. You got to get up early. Market opens at 9:30 Eastern Standard Time. You got to be up early, looking at all your positions, understanding what's happening that morning in the market in a lot of detail. Really, it's suited for people that have 4 to 6 hours a day they can dedicate to trading. Most people don't have that kind of time. I know that I don't have that kind of time. So for me, with a normal job, a family to take care of, I realized pretty quickly that that type of an approach wasn't going to work. Forget about that. Don't do it. Let me tell you why. All right, so if I'm not day trading, what is it that I'm doing? If you go back and watch my very first video, I lay out the results that I've had over the last 3 years. And I think they're pretty amazing. I mean, it's an average of 40% return each year. So as an example, if you started with $10,000 and you did 40%, the end of year one, you'd have $14,000. I mean, that's the kind of growth that can really transform your portfolio in not that long of a time. So what I'm doing is I'm doing position trading, which means I am choosing a stock that I believe is a great stock for a number of reasons that I'll lay out in another session, and I am diversifying my portfolio across 10 of these types of stocks, and I'm buying them with the intention of holding them for at least weeks, if not months, and occasionally over a year. But most of my position trades are months long, and they are based on fundamental quality of a stock, fundamental quality of a company. I'm not looking at charts to try to scalp a little, 30-minute or 60-minute or 3-hour change in the market. I'm focused on a longer term play, which means I do not need to spend 4 hours a day or 2 hours a day staring at charts and watching my positions. That's not the type of trading that I'm doing, because that doesn't fit my life. But I'm not sacrificing those gains because I'm still getting an average of 40% gains a year over the last 3 years. So that's 10 stocks. And those stocks are bought whenever it makes sense to buy them. We'll talk all about getting a list of how you choose those stocks and how you would choose which 10 and when to buy, and all those things. So that's what I'm doing. And that's point number one, full stop. So point number two, okay, keep it simple. A big reason why I chose to just simply buy companies that I liked and that I had good reason to like is that it's simpler. If you can look at a company, read a few documents, and I'll show you what to look at and what to do, and you can understand this is how this company makes money. This is why they're different from other companies like them. It's their competitive advantage. This is what I think of this industry. Like, these are things we can all understand, because hopefully you've got your own budget. You make a certain amount of money per month. You have to spend a certain amount of money per month. This is just like an organization. If you can understand how that company is making money, what kind of costs they have, etc., then you're going to be at least keeping it simple. I cannot state enough that you need to use this principle of keeping it simple and only buying things that you truly understand. I'll be honest, like, I am not I don't have a finance degree. There's a lot of investment tools that are complicated to me. And so I stay away from things that I can't clearly explain to other people. And it's worked for me. So that's point number two, keep it simple. All right, point number three, don't lose money. Yeah, I know this sounds really, really obvious. But one of the great things about position trading is that you have a lot of time that you can get ready to figure out, when should I buy this company that I like? I've found that the most important thing you can do in this type of trading is when you decide to buy something. Every company eventually goes on sale. Every stock eventually goes down to where it's really inexpensive relative to the real value of the company that you're buying. And so buying when these shares are really low really reduces your risk of losing money. And, because you're going to be holding these for a longer period of time, if for example, you buy shares in a stock and it goes down for a month, that's okay. Because as a position trader, you're not panicking and making adjustments at every shift and change in the marketplace or in the stocks that you hold. You have some time to allow your investment thesis, the reason that you bought that company, you have some time to let it unfold and go up in profit. And I'm going to go through a whole bunch of different trades that I've done and trades that I'm in the middle of as a part of this channel, so you can see exactly what I mean. And not every trade have I made money on. I have lost money on some trades. But in general, position trading makes it easier to manage your risk and to make sure that you're not blowing up your account by losing a bunch of money. And this next point, I cannot stress enough. I find it extremely risky for people that are new to trading to trade on margin. So doing options in ways that are not using their own money, but are using a broker's money or other people's money to trade. I find that just amazing that people would do that. So if we just take a step back here, basically, we're going to own a portfolio of stocks that we like, that we've bought at prices that we think are good prices. We're going to keep it simple. We're not going to use investment tools or options and things like that we don't understand or that aren't simple. We're going to buy companies that are simple and that we understand. We're going to spend the time that we need to, right? We have normal lives to lead. Once you've built your account up and it's really big and you're really making a lot of money trading, which can take a few years or a number of years, then maybe it can be a little bit different. But for now, we're going to just use the time that we need, and we're going to use position trading over months instead of doing day trading or swing trading, so that we can spend only the time that we really have in trading. And fourth, we're not going to lose money. We're going to protect our assets that we have, and we're going to protect our account by buying very carefully and by using the fact that we have time. Like if you buy a stock and it goes down, just wait. You've got a good thesis in mind, you can let it play out. And I'll even say this, here's something to think about. If you hold a stock for less than 1 year, you're going to be paying a much higher amount of tax on that stock. If you wait over a year, it goes to a long-term investment, and now your taxes you're paying are capped. So this is something you can use, and it helps you mentally to not get so concerned if a specific stock that you've bought is going down. And let me explain. So let's say you buy a stock and it goes down 30%, and it's not looking good. It's that big red line in your portfolio. And 6 months have gone by. You can just say to yourself, hey, I'm going to wait until 11 months and 15 days, and I'm going to look at this stock again. And if it's still down, well, one thing you can do is you can sell that stock for a loss before the end of the year, and it's going to help offset your gains that you've had in other places because it's a short-term tax and it's going to have a bigger impact. If you've had a really big gain, let's say you've gained 60% or 100% on that stock, waiting that extra 15 days to have it go over a year is going to save you a significant amount on taxes. So there's a few other tricks there we're going to go over in more detail. But that's to sum it up. Position trading with a 10 stock portfolio that you hold for months in order to make the gains. You are going to keep it simple. Buy simple companies that you understand. Don't start doing complicated things that you read about or that you watch on YouTube videos. 3, use just the time that you have. Don't put a whole bunch of time to this when you have a real job and your family you got to take care of. And 4th, don't lose money. Protect the assets that you've invested. Don't sell your losses right away, which may be counterintuitive in some cases. All right, so you might ask, how am I ever going to buy a stock on sale? Well, the reality is that the market is not logical. Over time it can be, but in the short term, the market responds very emotionally. And so there's a term that people use to refer to kind of the irrationality of the market. They call this mindset Mr. Market. Mr. Market is crazy. He wakes up in the morning, sometimes he's in a great mood and the market is up, and a stock is expensive. The next morning he wakes up and he's in a bad mood. The stock goes down. Does that company's stock actually reflect its value at all times? The answer is no, absolutely not. And let's take a really quick example. If you look up here at this chart, this is Apple, right? Simple company, at least simple because we all understand who Apple is and what they sell. So this is the last year, and if you look, back in let's see when this would be. Last August, right? August 2019, way pre-COVID, like none of the crazy stuff that's going on now is happening then. The stock is $193, all right? Fast forward to January 28th, the stock is at $317. We're talking about, like what, 40% increase over a period of months. Did Apple actually change that much? Was Apple truly 40% bigger around what they were doing by that time? The answer is no, they definitely weren't, right? Likewise, boom, you have the big COVID dip, March 24th, 2020, we're all the way back down to $224, which strangely enough, if you just look back to July 31st of 2019, it's pretty much the same price as at the absolute depth of the COVID dip for Apple. Now fast forward from March 23rd back to July 7th, and we've gone from $224 a share up to $376 a share. Now, this is just an example to say, if you have a company that you really like, and you assess that organization, and there's some rules that we'll go through about what you need to look at. But if you understand their business, you feel really confident about their financial position, and you feel confident about the direction they're going, and there's a lot of indicators you can use to know if a stock is on sale, meaning it's cheap, then you're going to have a chance to buy it. And here's the thing about it. It's all about when you decide to buy. So if we go and look at Apple's 5-year number, we can see, there's all kinds of fluctuations. And it's amazing to me how often I own a stock, or I'm assessing a stock to purchase, and I'm looking at comment boards and things like that. People's opinions of whether it's a good stock or a bad stock are usually just based on when they bought it. If they bought it expensive, they're like, this stock is terrible. I hate this stock, it never performs well. Meanwhile, other people bought the stock when it was cheap and they're thrilled, they're very happy. Stitch Fix is a great example of this type of a stock. We'll go into that, and I'll put a whole video together on trading Stitch Fix and how deciding when to buy, it has all the impact. I feel like that's the most important thing about this type of investing and trading, is choosing when to buy at what price. More important than anything else. If you buy a good company at the right price, it opens up all kinds of opportunity for you, and lots of options. If you buy it at the wrong time, it really doesn't matter what you do. You're going to struggle to even break even on that purchase. So part of this is learning how to identify really good companies that you like, that you understand, how to figure out what a good price to buy that company is at. Once you do those two things, everything else gets much easier, and you can have very, very large gains. So let's figure out more about how to do that. Okay, so my first year of trading, I made 40% gains on my portfolio, which is great. It's amazing. And really in that first year, I did one thing. I used some principles from a book called The Little Book That Beats the Market by a guy named Joel Greenblatt. I used some principles from that, as well as some additional refining principles about how to choose stocks. And I just bought those, and I held them for almost that full year. Not all of them, but most of them. And so there's a link down in the description of this video to go to Amazon to buy this book. It's great, it's simple to read, it's very good principles, and it gets you started at least from a mindset on how to think about selecting what companies to buy, how to think about ways to beat the market on a percentage year-over-year basis, why that's a good goal, etc. So anyway, a key component of this book is understanding how to very quickly generate a list of companies that you could view as being on sale. And one of the really key metrics about understanding a good company is figuring out how to identify really good management and good leaders in a company with a metric. And so one way to think about this is a really, really good management team knows how to take money, capital, and invest it back into their own company and get a really good return on that. Meaning they take some free cash that they've got, they put it back into their company, and they get a really significant result. That metric is called return on invested capital, or it's called ROIC. So this is a metric that you can get across a lot of companies. I mean, there's a few refinements to that Joel Greenblatt does in his book, but the great thing, and the very helpful thing, to be honest, that he does is he has provided a website that gives you a list of companies that meets certain metrics along these lines. And the name of the website, honestly, is pretty cheesy, but it is magicformulainvesting.com, and it's free, which is a pretty winning proposition. And I'll just show you a quick picture of this thing right here. So basically what this site does, you can see here from this picture, it's really, really simple, okay? And this is just a start. You get a list of these companies, and then you dig into them a little bit. The presence of a company on this list means that it fits certain criteria, that you're already starting out in a pretty good place. But if you take this list and you choose companies that you understand, you need to understand what you're buying. How do they make money? What makes them different from their competition? How are their earnings? And we'll get to that in a second. But you got to understand the company that you're buying. And then really, once you do that, you can select a good buying price. Now, if it's on this list, it probably is close to a good buying price already, because that's part of what this screener list is a company that has certain types of quality to it, and also is at a certain low price. And so this is where you start. And what I did is I just looked through these lists of companies. I had some principles in mind of the types of organizations I wanted to own, and then I just chose them and started researching them and ended up with a list of initially 5 companies that I really liked. And I basically just bought those companies. I didn't even really need to wait that long because, again, them being on this list already meant they were relatively on sale. And I knew that I had months, if not 18 months, a year and a half to wait for these companies to post a profit from a stock standpoint, and then I could sell those for an advantage. So I did. I bought my first 5 sets. And then about a month later, I bought my second 5 stocks. And I basically took my account and I broke it in, I just basically did 10% of my portfolio value in each set of stocks. And that was it. So I had my 10 stocks and each stock was 10% of my portfolio. Very simple. Again, keeping it simple, not trying to be fancy. And then I waited for that first year. So let me tell you next about how you do some research, the sites that I like to use, how you do research on a company that you're evaluating. And we'll take Allison Transmission Holdings. We'll just take the first one on the list and let's get to it. Okay, so one of the biggest things that I just want to make sure everybody is clear on is I really don't think you need to have some sort of special secret investing community, pay a bunch of money for different subscription sites, etc. I think that you can really learn most of what you need to know, if not all what you need to know about a potential investment, just from free information on the internet. So there's 3 sites that I use that I really like, and there may be others that I don't know about. Please comment other sites that you guys love that you've used, but there's 3 sites: Seeking Alpha, Yahoo Finance, and StockTwits. So one of the things that I've always been good at is leveraging other people's work to help me inform my own work. This has always been something I'm good at. I've been good at, and it's helped me be successful and help me really increase my own ability by using other people's ability. So I really like discussion boards because I like to have my own thesis about what I think. Like here's a good company, here's a good buy price, and I think I'm going to get this much value, like this much increase. I like to know what other people think and if they agree with me or not. So on Seeking Alpha, you're going to see a lot of articles and comments. Okay, so let's take an example. This example of Allison Transmission Holdings. So when I go to that to Seeking Alpha and look at Allison Transmission Holdings, one of the first things I see under the news section is B of A fires off favorite stock picks for new quarter. That's the name of an article. 37 comments. All right, I like the fact that there's 37 comments. I'm going to click on this thing, get an assessment of what B of A is saying about what they think. Now, I'll be honest. From an analyst standpoint, I have seen so many analysts just be so incredibly wrong. There's a few analysts that feels like you literally can just buy the opposite of whatever they say, and you're going to be in good shape. So I don't pay a lot of attention to the analysts. What I do like is to pay attention to the comments on Seeking Alpha. And so, you can come and look and really kind of read through what the comments are. There are some really, really smart people, both on Seeking Alpha and on, believe it or not, Yahoo Finance. Not all stock boards have good people on them in Yahoo Finance, but you can still get some good stuff. And basically, just start learning about A, what does this company do, and B, what do other people think of this company, and why do they think that? Because you're always going to find two sides. You're going to find a bear side, meaning that we don't think it's going to do well. And then there's the bull side, which is like, this is going to be great. It's going to do awesome. Assessing which ones of those have the best data and maybe the most people thinking that way about a company is a really good place to start. So I like using Seeking Alpha for that. I like using Yahoo Finance. So I'll just hit Yahoo Finance here real quick and see what they say about Allison Transmission Holdings. There it is. So I go to the Conversations tab on Allison Transmissions Holdings, and I sort by newest, and I just start looking at things, right? You'll see things about stock target prices. What do people think this thing should be worth? Different elements about discussion about what the company's doing, etc. And I will say that you do have stocks that are just underrepresented. People just aren't paying attention. Those can be super interesting. I'll have a few stories of stocks like that all they need is a little bit of attention and they blow up. And there's a whole strategy around buying those. So I use Yahoo Finance. They've got some good metrics and decent charts. And then the last is Stock Twits. Now, the internet is the internet, right? In many ways, the internet is a straight up dumpster fire of just trashy comments, and it's kind of a disaster. And I will say that sometimes Stock Twits and Yahoo Finance definitely fall into that category. But there's also a lot of really good commentators. And once you start looking at them, you can also follow the people that are good and pay more attention to what they're saying and kind of hash out the stuff that's not good. So I go to Stock Twits for the Allison Transmission page, and I see it, already somebody's referencing that Seeking Alpha article. There's one that was in the paid section that's got some good comments. There's some bullish folks on Allison, price target discussions. This just helps you, right? And so this isn't where you should get your investment thesis. Oh, and just to be clear, an investment thesis with positional trading is just three things. Do I like this company? Do I think they're a good buy? Do I know what price to buy at? What is my buy price? How low does it need to go before I'm like, this is great, I'm in? And third, what's my sell price? If I, for example, think I can buy a stock at 20, I already need to have an idea in my mind about where I'm going to sell it. Am I going to sell it when it's 40, when it's 30, when it's a certain percentage up? That is the thesis. And I'm telling you, with few exceptions, having a thesis before you buy is the way to go. and sticking to that thesis is also the way to go. There's a saying, me and my friend always are debating this. It's pigs get fat, hogs get slaughtered. The idea is basically that when you buy a stock and it starts to run up, like I've got a few right now that are at 50% up. That's pretty stinking good. Like I've got Sonos right now and it's 50% up, and it's tempting to sell it. But my target for it is still higher. So I'm waiting and I'm holding it. There's other times where it'll hit your target and it'll keep going, and it's really hard to know, do I sell now and take my 60% profit? Do I hold it? Because if I sell it now, maybe I'm missing another whole set of percentage profit. These are the great problems to have. I mean, I hope that all of you end up in situations where you're 60% up on a stock that you purchased and you're debating whether to take that gain and lock it in or to wait longer. And we can talk about putting limits and stops in to help protect your gains in another video. But going back to how you research a stock, and we're talking about Allison, the last thing, and really, actually, let me say this, the first thing is actually just reading the annual report. If you are going to look at a company, the first thing that I always do is I just look, what industry are they in? Is it an industry I kind of like? I mean, is it something I'm interested in? Because again, we don't have a lot of time. Like, I'm trying to spend no more than maybe 30 to 45 minutes a day tops. And there's whole days go by where I don't even look at the market. And so the time you have, use it really well. Is it a company I like? Are they an industry I like? And then you dig in and just assess, like, what does their annual report say? What did their last earnings report say? Read the transcript of earnings calls and see what analysts are asking. It's an easy exercise, guys. So honestly, just pick a stock that you like. You can go to the magicformulainvesting.com, pick a stock off of that, or just pick one that you like and do these things. Go to the website, look at the company, read the latest earnings report, read the transcript of the earnings call, check out what the analysts are asking them, see if you get a good sense of what's going on, and then assess what other people are saying. Look at Seeking Alpha, look at Yahoo Finance, look at StockTwits, get an assessment of whether other people also are seeing this as a good value purchase. In the end, really the type of investing this is value-based investing, but instead of investing for life into something, we're doing a shorter timeline because we're position traders. But a lot of the principles are still, really applicable. So just do that exercise. Take a company, 20 minutes, 30 minutes, you're gonna have a decent idea of what's going on. And again, those same principles we talked about in the beginning. Do you understand the company? Do you understand how they make money? Do you understand generally what their cost structure is, right? And is it complicated? Like, is it a company that just seems really difficult? I'll be honest, like there's times I look at a company and I don't get it. I don't understand how they're really making money or like why they're better than anybody else. Then just move on to the next stock. The key is to buy the things that you really understand and to buy them at good prices. So that's really the nutshell of how I did my first year. So we'll stop there for now.